In Hamlet, Polonius counsels his son Laertes that neither a borrower nor a lender be. Now, in Shakespeare's day, lending was done by individuals more than banks. But I believe this advice makes sense 500 years later when deciding whether or not to pay off your mortgage. Years ago, when mortgage interest rates were 7% and anyone could throw a dart at the Wall Street Journal and make 20% on a stock pick, stockbrokers were recommending that clients borrow the maximum allowed on their house and invest excess funds in the stock market. After all, using other people's money to make a buck should be a no-brainer. The clients made money, and the stockbroker did too. Everyone was happy. However, after the dot-com crash in the early 2000s, the stock market has not produced the lofty returns seen in the 80s and 90s. So let's assume you can choose between investing in a stock, paying a 6% dividend, or paying off your 4.5% mortgage. The math seems simple. You get a tax deduction and make an extra 1.5%. But to figure out the true impact, we need to dig deeper and ask some other questions. First of all, how much of a tax benefit am I really getting? In Arizona, with its fairly low income and property tax rates, there's often very little difference between total itemized deductions and the standard deduction. Now, you can easily determine how much you are actually saving by calculating your taxes with and without your mortgage interest. This can be done in a few minutes by your CPA or by yourself if you use a program like TurboTax. The results may surprise you. You may find that you are paying tax on the income and not getting much of an offset for the interest. Also, if you are comparing dividend-paying stocks to the totally safe investment of paying off your mortgage, you are really comparing apples to oranges. The stock price may decrease. The dividends may decrease. The company may go bankrupt. Look at nice, safe General Motors. The only true apples-to-apples comparison would be comparing your mortgage interest rate to other risk-free investments. Now, since I haven't seen a mortgage rate lower than the roughly 2% yield on the 10-year U.S. Treasury, paying off the mortgage makes good financial sense. The final part of this is the sleep factor. Being able to sleep at night knowing that you don't have that huge debt hanging over your head is a non-monetary benefit that, in my opinion, outweighs any small financial bit of leverage. Now, if you have excess cash, in general, my advice is to pay off the house. However, there are a few exceptions to this general rule. First of all, if your investment money is held in an IRA or other qualified plan and withdrawing the funds pushes you into a higher tax bracket. Secondly, if paying off the house exhausts your emergency funds. And finally, if your mortgage is greater than your home's value and you are considering walking away from your mortgage or doing a short sale. As a certified financial planner and a CPA, I can help my clients make important financial and tax decisions like whether or not to pay off their mortgage. If you would like some assistance with your future financial decisions and would like to explore more tax-efficient strategies, please give our office a call at 480-503-0050.
This has been a Loki production.